Here is the uncomfortable truth almost no retail trader wants to hear in 2026. The next big move in the S&P 500 will not be decided in New York. It will be decided in the gap between three central banks that are no longer reading the same script. The Fed, the ECB, and the Bank of Japan are now openly diverging. And that divergence is quietly loading the spring under the dollar, the euro, the yen, gold, and your favorite U.S. stocks. Let me walk you through it like a trader, not an economist. The Fed is stuck. Inflation refuses to die cleanly. The labor market is cracking in slow motion. And every time officials hint at deeper cuts, long-end yields jump and financial conditions tighten again. So policy becomes stop and go, and the dollar reacts in violent bursts instead of smooth trends. The ECB is on a different path. Growth in the Eurozone is fragile, energy costs are still a structural problem, and the bank is cutting more aggressively than the Fed at the margin. That widens real rate spreads against the euro, which is why EURUSD keeps failing at the same resistance zones and giving textbook short setups on the 4-hour chart. Then there is Japan. After years of being the funding currency of the world, the Bank of Japan is finally normalizing. Even small hikes matter because they force global carry trades to unwind. When USDJPY drops fast, leveraged positions in US tech and emerging markets get liquidated together. That is the real crash transmission channel most retail traders miss. So here is the practical part. In a policy divergence regime, you do not marry one bias. You map the cycle. When the Fed sounds more hawkish than the ECB, you favor dollar strength, look for EURUSD shorts on lower high structures, and expect the S&P 500 to grind higher with shallow pullbacks. When the Fed blinks and the BOJ tightens, you flip the script. You watch for USD-JPY breakdowns, you take gold longs on dips into prior demand, and you treat S&P 500 rallies as distribution, not trend continuation. Your defensive playbook is simple. Keep a core gold exposure as portfolio insurance, size your forex trades smaller during central bank weeks, and never hold leveraged USD positions into a Fed meeting without a hedge. Risk management beats prediction every single time. If this kind of macro-driven forex breakdown helps you trade smarter, drop the word divergence in the comments so I know to make the full Fed versus BOJ playbook video next.